please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
ICICI Bank's Chanda Kochhar is battling allegations of conflict of interest.
I can't even imagine that she could ever be a party to a transaction which could have a shadow of doubt. 3,250 crores of rupees represents a consolidation of the existing loans given to the Videocon and the subsidiary has not come out. No new loan has been given to Videocon. There's nothing to leverage upon. If Mrs. Kochhar has done something wrong, I think she should be in the limelight. If a point is made, that point has to be inquired into. But I think we should not jump into conclusions.
Well, spoken like a leader, spoken like a founder, and we will revisit that point yet again because we did see ICICI take down the Nifty and the Nifty Bank yesterday. Good morning. Welcome to Bazaar Morning Call. I'm Lata and with me is Sonia. Anuj still on a holiday. Well, what Anuj is missing now is a very big bull and bear fight perhaps that we are going to see today. To speak for the bears today is the fact that global jitters are certainly going to be on their side. Once again, the Chinese imposition of tariffs on 128 US products and as well, now the world rethinking whether those FANG stocks, Facebook, Netflix, Google, Amazon, especially after the Amazon tweet by Trump, the world rethinking whether tech stocks deserve the valuations that were given to them. For whatever reasons, we have seen like a balloon losing air, the global markets recede in terms of market cap. And below the February low, that could be technically important. So that's going to hurt the bulls and be in favor of the bears. But what will come in favor of the bulls probably is the Reserve Bank easing the provisioning rules for bond market losses that banks suffer. That could be positive for the bank stocks. And also what you just heard from Mr. Vaghul, that 6% cut in ICICI Bank, my sense is could be ameliorated somewhat because of the very spirited defense and a very important logical point he is making that no new loans were sanctioned to ICICI Bank, to Videocon by ICICI Bank in 2012. So these could be factors that will perhaps work in favor of the bulls, but we should remember that the market is sitting on fairly big gains overnight on a day when FIs have sold big. So, you know, they look like trader positions to me. Morning.
Okay, hi, good morning. Yes, that was quite a bit summarized in the first comment. But, you know, in a sense, I was reading a couple of reports that experts put out. They say that this trade war escalating is one thing and the impact it would have on the US market. But the other thing is that markets like India that have low exports of goods and services may actually benefit in the longer run. And, you know, that's something that even Sakti Siva was pointing out. So we talk about that in greater detail. Perhaps because India has sort of decoupled from the global markets, maybe it could now move on its own steam. You never know, but the global fall that we've seen could get exacerbated because of the NAFTA negotiations tweet that Trump put out as well, where he has now linked the proposal to build a border wall with US and Mexico with the NAFTA negotiations. So things could get worse there. But Lata, do you get a sense that maybe in the very near term we could sort of move in our own trajectory?
Well, it does look like, doesn't it? I mean, that's been the story of 2018 when, you know, we have clearly decoupled because of domestic worries. You know, the worries about this noise, the ICICI Bank noise, these kinds of things that, you know, there is a fraud or someone making a point probably in preparation to elections. That's something that might preoccupy markets. But just wanted to add, from your point of view, growth is intact, isn't it? If you looked at the auto sales numbers, Sonia?
Yes, it is. It's very much intact, and not just in, you know, the two-wheeler makers, the cars, but even the tractor makers have done extremely well. So rural growth is picking up, right? We've seen it with not just escorts, VST tillers and tractors, exceptionally good amount of sales. So I guess if the monsoon is good, that's what most you know, companies have indicated to us, at least an 8 to 10% growth for some of these rural players is a given.
Okay. Well, so the micros doing well. I mean, this is not new news for the market, so that may not be reason enough to perhaps move the needle in favor of the bulls too much. I think what's pulling in favor of the bears is the fact that there are a lot of knotty problems, say in the power sector and such like. But the government at this point in time doesn't want to take sides in case it is accused of cronyism. And because of that, and because of the plight of the banks, growth may suffer. So, you know, the message from the Credit Suisse investor conference was that perhaps the best of growth is behind us. And for this year, we will, you know, be in election mode and not see too much by way of resolution of issues. So we'll wait and see. There is an interesting battle between bulls and bears. So what have the experts got to say?
Well, as I was saying, you know, a lot of experts are talking about how India could be sort of, could decouple from the global problems. Sakti Siva is one of them, so we'll just get her view up on board. She believes that with rising fears over a trade war, it could be a common perception that one should hide in markets with a low exports of goods and services such as India, Indonesia and Philippines. However, she also reiterates 3 reasons why one should not hide in domestic markets. The first reason is that India, Indonesia and Philippines all run current account deficits which could potentially undermine their performance in dollar terms. She also says India and Philippines are still among the most expensive 4 on the Credit Suisse valuation model. And lastly, these domestic markets will continue to be associated with EPS downgrades. So she's a bit cautious there.
Okay, so not quite convinced that there is growth enough for EPS upgrades. And yes, the deterioration of macros would be an important thing, especially the current account deficit. So if you're not doing well on exports, then that clearly shows. But today we have a positive in terms of crude prices. So that may also add in favor of the bulls. Okay, more opinion coming in. Mahesh Nandurkar of CLSA believes that lingering macro concerns such as the twin deficits, rising oil prices, inflation and interest rates along with political uncertainties is likely to impact market returns even as the trend of corporate earnings has improved. It is unlikely to offset the impact of macro headwinds. Mahesh Nandurkar also believes that the upside for Nifty is now capped at 11,000 for this year, and the potential slowdown in domestic equity flows remains a near-term concern. In the CLSA model portfolio, they have added weight to IndusInd Bank and Emami at the expense of SBI and ICICI Bank.
Okay, let's also get you some money market views on how to trade that pocket this morning. We have Bhaskar Panda of HDFC Bank who expects the dollar INR pair to start above the $65 mark and trade in a range of 65.10 to 65.20. He says global crude prices remain high and we need to worry about that as well.
Okay, and Bhaskar, more importantly on the RBI circular that came in yesterday says the circular allows banks to postpone losses arising out of sharp bond movements in Indian markets. He expects the 10-year benchmark bond yield to open lower with a gap and probably trade in the range of 7.15. That's some kind of a low to 7.30. Some big bond gains probably in the offing.
Okay, but the US markets, the Dow saw almost an 800-point intraday fall and now has hit a new low for the year. Nigel is here to give us the world view. Nigel?
Well, that's right. The U.S. markets ended in the red, but the Dow, in fact, recovered nearly around 300 points from the low point of the day. A couple of technical factors. The S&P 500 ended below its 200 DMA. That's for the first time since mid-2016. And also the Nasdaq now has turned negative for 2018. Remember, the Dow and the S&P 500 already had negative returns for 2018. Now, in fact, Nasdaq has joined that list. Why did Nasdaq see selling pressure and why was it a big underperformer yesterday? Well, the FANG stocks, they got a sharp knock in yesterday's trading session. All of them were down in trade between 2 to around 5%. Now, there were 3 big factors really that played out. One was Amazon. Amazon was down nearly around 5% in yesterday's trading session. That's because over the weekend, Donald Trump said that Amazon is scamming the U.S. Postal Service. So that was point number 1. The second point was that China, in fact, they laid down some trade barriers or trade tariffs against U.S. imports. And the third factor was again on the back of Trump's tweet over the weekend. He's linking, building that wall that he's spoken about so often. And now he's talking about NAFTA as well in there. So on the back of that, those 3 factors, that's what really spoiled everything in yesterday's trade. Well, economic news, we looked quite good. The market, U.S. manufacturing PMI rose to around 55, so that looked pretty good. And in fact, we had the ISM manufacturing index as well. That looked pretty good in yesterday's trade. Europe markets, they were shut. But the Asian markets on the back of the weak overnight cues, well, all of them are sitting with cuts of around 0.5% to around 1%. And that would mean that the SGX Nifty as well will open up with a cut of nearly around 60 to around 70 points. Back to you all.
Okay, thanks a lot for that, Nigel. So let's take this story across to our next guest. Jeff Lewis joins in to talk about the global trade jitters and the impact that it could have on markets like India, sitting so far away. Jeff, hi, good morning. Thanks for joining us. What's your own view? India has problems of its own, a lot of domestic problems to deal with, so it has been underperforming so far. But what do you think the global trade war could do to markets like India now?
Well, I think it's more of a fright, a perception that we're going to have a trade war. I think it's really actually still quite unlikely. So I think the emerging markets have held up reasonably well. You might expect that they would have suffered most, I think. But that's not what we've seen in the first quarter. I think the emerging markets managed to stay reasonably calm. So I think that what we're seeing is that the U.S. now wants to sit down with China and go through some of these issues. It is going to cause volatility for markets. But at the end of the day, the global economy is pretty strong. Earnings estimates for 2018 have been revised up by about 3.5% since January. So I'm still reasonably constructive towards the equity markets for the remainder of 2018.
Morning, Jeff. There seems to be, these intermittent noise, one or the other, coming in from Donald Trump. Either it is on the technology stocks, or this time it's on linking NAFTA to Mexico. On the other hand, there seems to be a serious rethink on the valuations given to, say, a Facebook or an Amazon. Given that, do you think, at least for now, we've already seen the best in terms of, Wall Street indices? Will we reach those highs again very easily?
I think there's a good chance, looking at a U.S. economy where growth is likely to pick up this year, where you've got earnings now expected to come in pretty close to 20% because of the tax reforms. I think it would be unlikely, not very likely to see a big down year for U.S. stocks. But of course, I don't think anybody was expecting at the start of the year that we'd see a repeat of the kind of returns we had last year. So I think we'll still scrape some returns, positive returns, from these markets, but it's not going to be a banner year. That's obvious by now, I think.
So can we summarize this by saying that you believe that this could be more like a time-wise correction that the market sees through the course of the year, and no major price correction?
I think we're going to see volatility. I don't think we're going to see a big bear market. Yeah, so I think that's basically what you've just outlined is probably the most likely scenario now.
Okay. All right. We'll leave it at that. If it's just volatility and not a bear market by these standards, we can take that. It's a correction territory, I think, now with 10% losses in a couple of the indices. I think we are in correction territory, nowhere near bear territory. Well, but that was the negative for the Indian markets today. The positive comes from, of course, Reserve Bank, in a major relief for banks. The Reserve Bank allowed scheduled commercial banks to spread their bond losses over 4 quarters, over 1 year, that is. P.K. Gupta, Managing Director, State Bank of India, joins us. There's also Mr. Ravi Krishnan of UCO Bank with us. In a bit, we'll also get Vivek Rajpal to tell us how bonds might move. Good morning, all of you gentlemen. Mr. Gupta, what's your sense, sir? Can this keep most of the banks in the green, or this is going to be a minor advantage, considering the big NPA losses?
No, I think these are two separate things. First of all, I think this is a very welcome move which the RBI has done. See, what had happened on the bond yields was a little bit of an extraordinary. The yields had run up quite a bit, and we do think that there would be a correction that would be happening there. Yes, the banks already had a problem on account of provisioning for the NPAs. So this was an added problem which the banks were facing. So hopefully this should actually ease the pressure on the banks for the fourth quarter profits, actually.
Okay. Mr. Thakkar is also with us, the MD and CEO of UCO Bank. Mr. Thakkar, morning. How much relief do you see for the banks because of this move?
Your bank in particular?
Yeah, no doubt it's a good move, and especially in the December quarter, we had to make quite big substantial provisions. So now we'll be able to spread that over 4 quarters. So it may not be a big relief in the sense that we have to make a lot of additional provisions on account of the NCLT and the new RBI norms. But definitely it will give some breathing space. In the sense, I will be able to write back the amount which I had written off in the December quarter. It's a good move. I think because in case in the future the interest rates again they are not the downward trend, then it will be help me in just spreading my this risk over a period of say 1 year.
Can you tell how much was your losses, Mr. Krishan, in the Q3? We know that State Bank had 3,400 crore of mark-to-market losses. What did you have?
We had around 450 crores.
Okay, and
in the last quarter, yeah.
Okay, but will that be enough? The spreading of this enough to counter what you will have to provide for the new NPA rules?
No, I think the amount which we had to provide for the new NPA rules is much more.
Much more.
That's why I told you it will, to some extent, it will help us, give us some breathing space.
Okay.
But in the long run, the NPA provisions are much more higher.
Okay. Yeah, Mr. Gupta, yeah, I take your point, sir. Sorry. Mr. Gupta, I just wanted to ask you, will now banks buy bonds? Because you all don't have this overhang of having to provide immediately, and also because there are more short-term bonds and fewer 10 to 15-year bonds. Do you see banks returning to the market to buy?
No, I guess some liquidity which does come into the banks actually will go towards buying of the bonds actually. See, what is also happening actually is I think you need to look at basically how fundamentally the bank's bond portfolio is changing over a period of time. So one is that we are moving away from SLR to the LCR regime. Okay. So under LCR regime, as of now, I think the requirement works out to something like 18% of the bank's net deposit term liabilities actually. Okay. And 11% out of the SLR is allowed to be used for that. So 7% of LCR which the banks maintain outside the HTM book, which is subject to the mark-to-market actually.
Okay.
Okay.
So that means almost 27, 28% you have to keep in bonds.
Absolutely.
SLR plus LCR.
Absolutely. So that is where I think, and the bond portfolio has been rising for the banks because one is credit offtake was low for the last 2 years. Monetization money came in, some of it which got parked actually. Okay. And the corporates have been moving from the loan market to the bond market in the last 2 years also. Okay. So all of that also leads to the bond portfolio. So the thing is that whether the banks like it or not, the bond portfolio which is parked in the AFS and the HFT would be definitely substantially higher, which would require mark-to-market on a regular basis actually. And secondly, whatever liquidity comes, whatever the offtake happens in the credit market, I don't really think, that full... the credit market disbursements have started to the extent the banks have been getting deposits. So some investments in the bond market will happen actually. But, the shorter term bonds do give little more flexibility to the banks to be able to invest.
Okay. Vivek Rajpal is also with us. He's the rates strategist at Nomura India. Vivek, hi, morning. Do you also believe that this could be just a temporary relief for PSU banks? Because a lot of the mark-to-market related provisioning was quite large in the previous quarter, that is in Q3.
Yes, that's what our banking analyst also seems to be suggesting. Having said that, I think what is important is this is a welcome relief for the bond markets. We have now got a 2 set of news, which one was a positive surprise on the supply front, and this tries to tackle the demand angle, especially from the domestic banks front, which was becoming increasingly an important issue.
So you expect them to buy? Mr. Gupta said that that there are reasons to buy bonds. What do you expect will be the bond yield today and for the remaining part of April?
All right. So, Lata, yes, relative to what banks' participation would have been, we will definitely see some increase in buying from the banks. Though it may still not be to the levels which we used to see in previous years, and therefore any further news on raising of FPI limits, etc., will be also an important consideration. As far as bond yields are concerned, I think we should settle around closer to 725 kind of a zone, at which probably 10-year bonds yields will stabilize.
Well, that's good to hear. Well, Mr. Gupta, before we let you go, wanted to ask you about this, improved bidding that we have seen, especially for the steel assets. Now we have three very powerful players for the SR Steel asset itself. We understand JSW, New Metal, Arcelor and Vedanta are all three in the race. Will any of this, will this mean that bond losses, NPA provisioning gets considerably reduced in the first quarter for a bank like State Bank, which has a lot of steel assets?
I think before I talk about that, I think just on this bond yield,
sure.
I think your earlier, also somebody commented that the bond yields may correct to 715, 720.
Yeah.
So if the bond yields do correct to those levels, so I think most of this provisioning may not be required. So I think what may happen probably is that, like this quarter, banks would be writing back something.
Oh.
And beyond which, actually, if the bond yields do come down to 720, 725 level, so further provisioning may not be required. So the benefit of this circular, which is available over the 4 quarters, I think would practically be used in this quarter, maybe a little bit to the next quarter, actually. So beyond which it may not be required, and the banks will be able to actually manage with the whatever provision they have already made, actually. Okay. And secondly, yes, I think this NCLT, we have been saying that the first NCLT lot, actually, the banks had made enough provision. So I think going by the bids that have been received, so we think that the provisioning already made would be good enough to take care of whatever haircuts the banks have to take. And in many cases, we could be seeing some write-backs also.
Okay. No, actually, the bids have been opened already for ArcelorMittal, for Electro Steel, for Bhushan Steel, etc. What is the percentage haircut that you are expecting in steel? Much lower than 50? How much?
I think it won't be right to talk about this, actually. I think these things are still getting discussed. But as I said, I think in many of these cases, the haircuts are much lower than what markets have been anticipating.
What is your steel exposure, sir, total, in the NCLT?
NCLT, I think we have a quite sizable exposure. But again, all the steel exposures we have been, the bids have been rather good, actually.
Yes,
okay.
Yes. All right, so we'll leave it at that. Mr. Gupta, Mr. Tucker and Vivek, thank you very much for joining us with those details. So several takeaways over there. One, that you may see bond yields going towards 7.25, 7.2, according to Vivek. And from the bankers, it's a minor provisioning advantage. But of course, the NPA provisioning remains.
Okay, well, let's see how these stocks move. Yesterday was a good day for a lot of these names. Let's see how they react today. But let's take a break on that note. On the other side, we'll talk about CNBC TV18's top 10 list of stocks to watch today.